Welcome to the Deep Dive, the show where we take a stack of information, cut through the noise, and extract those surprising nuggets of knowledge you need to be truly well-informed. Today, we're tackling a really fascinating and incredibly important area of professional practice. In our increasingly complex business world, you hear terms like due diligence, investigation, and forensic accounting thrown around constantly. They sound familiar, right? But what do they really mean? And, crucially, how are they distinct from each other? Today, we're taking that deep dive into these three crucial areas of professional accounting and examination. And for you, whether you're gearing up for an important case-based exam or just want to truly master this material, our mission is clear. We want to break down these concepts, highlight their precise definitions, understand their unique purposes, and really clarify their distinctions. We'll also explore how they're applied in real-world scenarios, making sure you not only grasp the theory but also see it in action.
That's right. And to achieve this, we're drawing from some truly authoritative source material today. We'll be using its exact language and terminology that's deliberate to ensure you become intimately familiar with the phrasing you might encounter. In professional contexts and, of course, on your exam. It's about building a really robust foundation, not just skimming the surface.
Okay, let's unpack this then. Before we dive into the intricate details, maybe the nitty-gritty, let's establish a clear understanding of what due diligence, investigation, and forensic accounting actually mean. And let's start with a foundational example. Imagine a student, let's call him K, preparing for his final Chartered Accountancy or CA exam. Now, he had an inkling of these terms, they sounded familiar, but he lacked knowledge about fine distinctions among them. That's precisely the journey we're embarking on together today, moving from a general sense to a really razor-sharp understanding. So first up, due diligence. Our source tells us this broadly means, taking care before entering into agreement or transaction with a party which a reasonable person ought to take.
Right. Taking reasonable care.
And here's a crucial insight. It's not an exclusive activity bracketed for chartered accountants. Anyone can perform it.
Exactly. It's essentially about exercising general prudence, being careful before you commit.
Think of it like looking under the hood before you buy the car, maybe.
That's a good analogy.
Okay, then we have investigation. Now, this one is aimed at establishing a fact or a happening or assessing a situation. Unlike the general prudence of due diligence, an investigation has a purpose that is specific.
Yes, it's targeted. The source highlights scenarios like a chartered accountant being engaged to discover whether a fraud has occurred or where an entity proposes to buy a business. It's focused inquiry, not just broad caution.
Got it. And finally, forensic accounting. This term relates to the use of professional accounting skills in matters involving the possibility of a fraud in order to collect relevant evidence and facts which would help support an expert view for potential or actual civil or criminal litigation.
And the absolutely critical element here, and this is what truly sets it apart, it's that the evidence should be suitable for use in court of law or before a regulatory body.
So that legal context.
Precisely. The admissibility of evidence is the defining characteristic of forensic accounting. It's essentially accounting in a courtroom setting, or at least with that potential in mind.
That's a perfect foundational overview.
And to truly bring these definitions to life, demonstrate their real-world application, let's connect them to a concrete scenario. This comes directly from our source material. Picture a Surat-based company. They're heavily involved in importing raw diamonds and exporting finished ones, plus domestic sales.
Okay.
This company had availed significant credit facilities, specifically 250 crore Indian rupees, from a consortium of 5 banks. These facilities included various forms of credit, cash credit, term loans, the works.
Like a substantial amount.
Yeah, substantial. Now, the situation turned critical when the account was declared a non-performing asset, or NPA.
Meaning the loan went bad.
Exactly, due to a failure to meet repayment obligations and other defaults. And to add another layer of complexity, the company had frequent trade transactions with its sister concerns.
Related parties.
Yeah.
Always a potential complication.
Always. So this kind of scenario immediately spotlights the vital need for these specialized services we're talking about. When a major credit line becomes an NPA, and there are transactions with related parties like sister concerns, questions naturally arise.
Like, was the funding genuinely needed in the first place?
Right. Were the credit facilities proportionate? And what about potential fund diversion or siphoning off through those sister concerns? These are the real-world pressures that demand a deeper look.
So how would a forensic professional tackle this?
Well, their method would center on meticulously gathering facts and evidence, then a critical examination for any violations, This means a detailed review of financial data, often spanning a significant period, specifically looking for what the source calls red flags.
Those subtle but crucial indicators of irregularity.
Precisely. It also involves leveraging computer-assisted techniques to unearth digital evidence. You can't ignore the digital trail these days. And beyond the numbers, reviewing physical documentation and gathering market intelligence are crucial.
Market intelligence, like what competitors are doing.
Or pricing, industry trends, anything that provides context. And significantly, conducting interviews with key employees can be immensely helpful in uncovering the truth. This multifaceted approach is exactly what's required to trace the trail of funds and determine precisely what happened, and importantly, where the money really went.
Okay, that makes sense. A real deep dive is needed there. Now that we have those initial definitions firmly in mind, let's zoom in specifically on due diligence and really explore its depth. Because this isn't just a buzzword, is it? It's a fundamental principle of sound business.
Absolutely not just a buzzword, it's foundational.
At its core, due diligence is about investigating and evaluating a business opportunity thoroughly. This comprehensive process includes verifying agreements, confirming encumbrances on assets, meaning any claims or liabilities against them.
Like liens or charges.
Right. And establishing clear title and ownership of those assets. It extends to intellectual property and even ensuring compliance with health, safety, and environment laws. The underlying principle is a general duty to exercise care in any transaction.
And as our source beautifully puts it, due diligence is a measure of prudence activity, or assiduity, as is properly to be expected from and ordinarily exercised by a reasonable and prudent person under the particular circumstance.
Yep.
Not measured by any absolute standard, but depends on the relative facts of the special case.
It's about exercising that common sense caution adapted to the situation.
Exactly.
For investors, due diligence is a structured process, an investigation into the details of a potential investment. This includes examining operations and management and verifying all material facts.
It entails conducting inquiries for the purpose of timely, sufficient, and accurate disclosure of all material statements, information, or documents. Anything that might influence the outcome of a transaction.
And this isn't just about financial numbers, is it? It involves a careful study of both the financial and non-financial possibilities for the successful implementation of, say, restructuring plans.
Absolutely. It's holistic.
You'll see due diligence applied before acquiring a controlling interest in a company, for example, to confirm that the business conditions align with what's been presented. It's also vital for investment recommendations, or when a bank is advancing a loan or credit facility.
Think about the broad range of scenarios where it's required. Corporate restructuring, venture capital financing, lending arrangements, leveraged buyouts.
Public offerings, disinvestment processes, corporatization initiatives, the list goes on.
Even when a business unit remains within a group but changes management during a restructuring, due diligence is essential.
And there's an emerging area too, right? The source mentions it.
Yes, and it's increasingly important. Highlighted by the OECD's due diligence guidance for responsible business conduct, its mandatory human rights and environmental due diligence. Here, enterprises are expected to identify, prevent, mitigate, and account for how they address actual and potential adverse impacts to people, society, and the planet.
Wow. So it's truly a broad and encompassing concept in modern business.
It really is. And that comprehensive overview leads us to a crucial point of distinction. This is especially vital for anyone preparing for a professional exam, the difference between due diligence and a financial audit.
Ah, yes, a common area of confusion.
Very common.
Yeah.
But their purposes are fundamentally distinct. Let's clarify this. An audit, formally defined, is an independent examination and evaluation of the financial statements on an organization with a view to express an opinion thereon.
So it's about forming an opinion. True and fair view, historical performance, that sort of thing.
Precisely. It's about historical financial statements. Now, due diligence, on the other hand, refers to an examination of a potential investment to confirm all material facts of the prospective business opportunity. It involves a comprehensive review of both financial and non-financial records as deemed relevant and material to the specific transaction.
So it's about confirming facts before a deal.
Exactly. Simply put, due diligence aims to take the care that a reasonable person should take before entering into an agreement or a transaction with another party. The core distinction, therefore, is crystal clear. An audit provides an opinion on past financial statements. Due diligence is about confirming facts before a transaction takes place.
Fundamentally forward-looking and transaction-specific.
You got it. Rather than backward-looking and opinion-driven like an audit.
So given these clear definitions, Why is due diligence so incredibly important in practice? Our source material outlines several key reasons that make it pretty much indispensable. Firstly, it helps to confirm that the business is truly what it appears to be. You're not just taking someone's word for it, you're verifying every significant claim.
No surprises, hopefully.
Right. Secondly, and this is critically important, it helps identify potential deal killer defects in the target company. This allows you to avoid a bad business transaction altogether, preventing you from walking into a financial nightmare unknowingly.
A very expensive mistake to avoid.
Absolutely. Thirdly, due diligence provides you with the crucial information needed for valuing assets accurately. It also gives you the data required to define representations and warranties in the contractual agreements, and it strengthens your position for negotiating price concessions.
Gives you leverage based on facts.
Exactly. Leverage and data to make truly informed decisions. And fourthly, it helps verify that the transaction you're considering complies with your own specific investment or acquisition criteria. Typically, this thorough, detailed due diligence is conducted after the parties have agreed in principle.
After the handshake deal, maybe?
Sort of, after a preliminary understanding has been reached, but crucially, before the signing of a binding contract. It's that final, rigorous check that can save you millions.
Indeed. And for a more structured understanding, due diligence can be classified discipline-wise into several categories. This classification helps in understanding the multifaceted nature of the exercise, highlighting that it's far more than just a financial review.
Okay, what are these categories?
First, we have commercial or operational due diligence. This is typically performed by the acquiring enterprise itself, evaluating the target from commercial, strategic, and operational perspectives. For instance, determining whether a proposed merger would actually create those promised operational synergies. You know, the 1 + 1 = 3 idea.
Seeing if it actually makes business sense.
Right. Then there's financial due diligence, which involves analyzing the books of accounts and other financial information. This is often performed after commercial due diligence, building on those strategic insights. Next, tax due diligence. While a separate exercise, it's absolutely integral to a company's financial status and looks at the tax implications and effects of a merger or acquisition. Very important.
Can't forget the tax man.
Never. We also have information systems due diligence, which pertains to all computer systems, IT infrastructure, and related matters crucial in today's digital world. Legal due diligence reviews the legal aspects of the entity's functioning, such as property ownership, contracts, and statutory compliance. Environmental due diligence assesses the entity's environmental impact, its flexibility, and adaptiveness to regulations, increasingly vital.
And the last one.
Finally, personnel due diligence. This examines personnel policies, contracts, and talent alignment to ensure they integrate seamlessly with the requirements of the restructuring. Are the right people going to stay?
That makes sense. You need the people too.
Yeah, absolutely. And it's important to note, particularly for your professional understanding listener, that financial due diligence is sometimes misinterpreted as the complete due diligence review. Given its centrality in assessing financial implications, people sometimes stop there. But as our source clearly states, this isn't always appropriate unless its scope is broad enough to cover all relevant aspects.
So, true, comprehensive due diligence needs to span all these disciplines.
Ideally, yes, for a truly holistic view.
Okay, let's really deep dive into financial due diligence now. As you said, it's often the central pillar of the entire exercise. The principal objective here is, as the source describes it, to look behind the veil of initial information provided by the company and to assess the benefits and costs of the proposed acquisition merger by inquiring into all relevant aspects of the past, present, and future of the business.
Getting beyond the surface-level data, understanding the true financial health and potential.
Exactly. So to achieve this, a full-fledged financial due diligence typically includes a rigorous review of several key areas. It starts with a brief history of the target company and the background of its promoters. This helps you understand its turning points, market share, product life cycle, any regulatory impacts. The whole story.
Context is everything.
Then, a careful study of the accounting policies and practices is undertaken. This means looking for any inappropriate policies or maybe recent changes that might have been made specifically with a view to sale.
You need to know if they suddenly changed how they value inventory just before putting the company up for sale, for instance.
Good point. The overall scope of the due diligence needs to be based on these policies, and any material changes or differences from the acquiring entity's policies must be highlighted. Next, a thorough review of financial statements is crucial, checking compliance with governing statutes, frameworks, relevant accounting standards.
All the baseline checks. Any deviations noted, of course.
Right. But beyond compliance, it's about evaluating the operating results in great detail, as the company's price is largely based on its profitability. You'd compare actual figures to budgeted and previous periods, analyze trends over maybe 4 to 5 years, and benchmark against similar companies to arrive at a normal operating profit.
This also helps in providing an indicative valuation. And for significant assets like immovable properties or large plant and machinery, you might need expert valuers, right?
Yes, the source mentions calling in expert valuers. The net worth assessment considers potential over- or undervaluation of assets and liabilities, with particular attention paid to intangible assets, which can be tricky to value. Now, here's a really crucial point, and it's a key area that often features in exam scenarios: identifying hidden liabilities and overvalued assets.
Ah, yes, the potential financial landmine.
Exactly. These aren't just line items. They can utterly derail a deal. Their true insight lies in how insidious they can be because they actively don't appear on typical financial statements. Finding them is a real art.
So what are we looking for with hidden liabilities?
Well, things that aren't immediately obvious on the balance sheet but still pose a significant risk. Think show cause notices that haven't yet matured into formal demands but could be material. Or letters of comfort given to banks, which aren't formal guarantees and so often undisclosed.
Tricky.
Very. The list goes on. Scenarios where a company sold subsidiaries but agreed to indemnify their prior liabilities, or facing product and warranty claims, or involved in ongoing litigation. Tax liabilities are prime suspects too, like long-pending sales tax assessments or final customs duty assessments where only provisional assessment was done.
Future lease liabilities, environmental problems, unfunded employee benefits like gratuity, superannuation, leave, salary, especially if the actuarial valuations are dodgy.
Correct. And huge labor claims under negotiation or unresolved labor litigations.
Hmm.
They all fall into this critical category. The key is knowing where to dig beyond the obvious figures.
Okay, and on the flip side, overvalued assets. What are the common culprits there?
This means assets appearing on the books at a value higher than their true worth. Common examples include uncollected or, frankly, uncollectible receivables, or obsolete, slow-moving inventories, or those valued above their net realizable value, maybe large stocks of packing materials with the company name that have no resale value.
Things you can't actually sell for what the books say.
Exactly. Underused or obsolete plant and machinery, along with their spares, often sit on books at inflated values. Assets impaired by a sudden market fall, but not written down. Assets carried above market value due to improper capitalization of expenses or foreign exchange fluctuations. Litigated assets where ownership is uncertain.
What about investments?
Investments carried at cost despite a much lower realizable value, or those earning a very low rate of return. Infructuous project expenditure, deferred revenue expenditure that won't yield future benefits. Group company balances under reconciliation that might never be recovered, and intangible assets of no real value. Identifying these is paramount to arriving at a true and fair valuation.
It's a minefield if you're not careful.
Definitely. Beyond these specific asset liability checks, the financial due diligence extends to taxation checking regularity of payments and the tax effects of the merger. Cash flow analysis is vital. Understanding the company's historical cash-generating abilities, its capacity to honor commitments, how well it converts receivables and inventories into cash, and its fund deployment and investment patterns.
Seeing where the cash actually comes from and goes.
Precisely. Financial projections for the next 5 years are obtained, ideally on optimistic, pessimistic, and most likely bases. You need to thoroughly check the assumptions for realism and arithmetical accuracy.
Assumptions are key there. Garbage in, garbage out.
Absolutely. The management and employees are also scrutinized. Excess workforce, clarity of job profiles, impact of labor law litigation, proper funding of employee benefits like PF, ESI, gratuity, often needing actuarial valuation. Key employee pay packages, ESOPs, and identifying critical personnel who might not continue post-acquisition. That's a big risk.
Losing key talent can sink a deal's value quickly.
For sure. Finally, statutory compliance involves listing all applicable laws, creating a compliance checklist, and quantifying any punitive charges from non-compliance. It's a truly comprehensive look under the financial hood. So, given all this complexity, how do you actually conduct this intricate process?
Well, the source emphasizes starting with an open mind. Don't go in assuming something is wrong, but rather identify potential trouble spots and ask for thorough explanations.
Makes sense.
It's also critical to get the best team of people. If you don't have the internal staff or expertise, especially for a business in an unrelated industry, hiring experienced due diligence experts is highly recommended.
You mean specialists.
Absolutely. This means getting help in all relevant areas: finance, tax accounting, legal, marketing, technology, any other discipline, really, to gain that 360-degree view of the acquisition candidate.
And it's not just internal records, is it?
No, the source highlights that talking to customers, suppliers, business partners, and even employees are great resources for information. Get the outside perspective. It's also crucial to take a risk management approach. While thorough research is necessary, you don't want to antagonize the target company's team by overwhelming them with questions or appearing overly suspicious. It's a balancing act.
Keep the relationship constructive.
Exactly. The process culminates in preparing a comprehensive report detailing the compliances and substantive risks issues. Our source even mentions a six-dimensional process framework: diagnose, design, define, defend, discover, and delivery as a model, but stresses that you need to adapt it to unique situations.
So once all this meticulous work is done, the culmination is the due diligence report. What goes into that?
Right, the final output. While the contents will always vary with individual circumstances and the specific scope agreed upon, an illustrative list of headings helps consolidate the typical output. This report typically begins with an executive summary, the key findings up front, followed by an introduction and background of the target company, clearly stating the objective of the due diligence and the exact terms of reference and scope of verification.
Setting the stage clearly.
Precisely. Subsequent sections detail the brief history of the company, its shareholding pattern, and crucial observations from the review capturing those key findings. There will be an assessment of the management structure, a thorough assessment of financial liabilities, and an assessment of the valuation of assets. Specific comments on properties, terms of leases, liens, and encumbrances are included, alongside an assessment of operating results, an assessment of taxation, and statutory liabilities.
Covering all the bases we discussed.
Exactly. The report also delves into the assessment of possible liabilities on account of litigation and legal proceedings against the company, an assessment of net worth, and details of interlocking investments and financial obligations with group or associate companies. Crucially, it will cover amounts receivable subject to litigation and any other likely liability not provided for in the books of account. Those hidden ones again.
The SWOT analysis comes in here too, right?
Often, yes. A SWOT analysis identifying strengths, weaknesses, opportunities, and threats is commonly included. There will be comments on future projections, a status of charges, liens, and mortgages on company assets and properties. And finally, it provides suggestions on ways and means, including affidavits and indemnities, to cover unforeseen and undetected contingent liabilities, and suggestions on various aspects to be taken care of before and after the proposed merger or acquisition.
So it really becomes the definitive guide for making that critical business decision.
It should be. To connect this directly to a scenario you might face in an exam, listener, consider an example from our source, similar to Test Your Understanding 1. This involves a chartered accountant, let's call her CAY, employed with a leading private sector bank. She's performing due diligence for a loan proposal for a garment manufacturing unit. During her review, she notes factors like the company's recent formation, rapid sales increase, cash profit generation, and timely debt servicing as clear strengths. Obvious positives. However, she also identifies a demand slump in the U.S. market and a reliance on the main promoter's individual marketing skills due to a lack of well-paid, qualified staff as significant weaknesses or threats.
Seeing both sides of the coin.
Exactly. The act of jotting down and elaborating on these points, the proactive identification of internal and external factors, is precisely what the source identifies as performing a SWOT analysis as a key part of financial due diligence. It directly applies the concepts we just discussed in a practical, real-world context for a lending decision.
That's a great practical example.
And this also directly relates to several theoretical questions you might encounter in your exam. For example, you might be asked about the procedures for due diligence on a specialty chemicals business acquisition.
Or the specific content of a due diligence report for a listed Indian company.
Right, or what to check to assess a manufacturing unit's cash-generating abilities. Understanding these components in detail is not just academic, it's absolutely essential for practical application in real-world, case-based exam scenarios, and frankly, for your career.
Absolutely. Okay, now let's shift gears completely to investigation. A term, as you said, often confused with audit, but one with critical distinctions that are vital to grasp. especially for professional exams.
Very important distinction.
Our source material defines investigation as a systematic and in-depth examination or inquiry to establish a fact or to evaluate a specific situation. In simpler terms, it means an inquiry into facts. Professional accountants are frequently required to investigate accounts or related matters and records.
It can also be defined as an examination of books and records preliminary to financing or for any other specified purpose, sometimes differing in scope from the ordinary audit.
So investigations can cover a range of areas: financing decisions, investment decisions, cases of suspected fraud, or even determining profitability or cost.
The key insight here is that an investigation is always about digging deep for a specific, often predefined reason. It's not a general checkup.
Right, it has a target.
Precisely. And this brings us to a truly crucial distinction for you, listener, particularly for exam preparation: the detailed differences between an audit and an investigation. Our source tabulates these differences clearly, and understanding them is paramount. Let's walk through them.
Okay, let's do it.
First, let's look at the objective. An audit aims to express an independent opinion on whether financial statements display a true and fair view of an entity's affairs.
The audit opinion.
Right. An investigation, however, aims at establishing a fact or a happening or at assessing a particular situation. The goal is factual determination, not opinion.
Fact-finding versus opinion-giving.
You got it. Next, consider the scope. An audit scope is generally wide, often statutory, determined by relevant law or professional standards. An investigation scope, conversely, is narrow and specific. It can be statutory-like under various sections of the Indian Companies Act, 2013, sections 210, 212, 213, 216, which mandate investigations into corporate affairs, particularly in suspected misconduct cases.
Or it can be non-statutory.
Exactly. Driven by specific client needs, like a potential buyer wanting to investigate a target company's inventory valuation.
Okay. What about timing?
Good question. Periodicity. An audit is typically carried out regularly, quarterly, half-yearly, yearly. An investigation, however, is not limited by a rigid time frame. It may cover several years, as its outcome isn't certain, and it follows the trail of evidence wherever it leads.
So it could go back quite far if needed.
Potentially, yes. In terms of nature, an audit involves test checking or sampling techniques and is mandatory for many companies under law. An investigation, conversely, requires a detailed study and examination of facts and figures. It's usually voluntary unless mandated by a specific statute or court order. Much more digging involved.
And limitations. Audits have inherent limitations, right?
They do. By their very nature and reliance on sampling, audits suffer from inherent limitations in detecting all misstatements. An investigation, due to its specific and in-depth engagement, has no inherent limitation, technically. It can delve as deeply as necessary to find the facts.
What about the evidence they look for?
Significant difference here. The type of evidence sought differs greatly. An audit is mainly concerned with prima facie evidence that looks sufficient at first glance. An investigation, critically, seeks conclusive evidence. It's not satisfied until the facts are definitively proven, needs solid proof.
How about following accounting rules?
Their observance of accounting principles varies significantly. An audit is strictly governed by generally accepted accounting principles, GAAP, specific audit procedures, disclosure requirements. An investigation is analytical, thorough, and importantly, not bound by accounting conventions, policies, and disclosure requirements. It allows the investigator to follow the evidence wherever it leads, regardless of how it's categorized in the book.
Interesting. And who hires them?
The appointing agency can also be different. An auditor is typically appointed by the owners or shareholders of a company. An investigator, however, can be appointed even by a third party, like a bank considering a loan or a prospective buyer.
Okay. Add a reporting.
The reporting outcome for an auditor is a formal report to the owners expressing that opinion. An investigator reports their findings directly to the specific persons on whose behalf the investigation is carried out, tailored to the client's needs.
This leads to the mindset difference you mentioned earlier.
Absolutely. This is a fundamental difference in mindset. An auditor does not suspect unless circumstances are there to arouse suspicion. Their starting point is professional skepticism, yes, but not inherent suspicion. A key phrase from our source states that an investigator, however, approaches the work with a frame of mind to suspect, verify, and satisfy. This proactive, inquisitive, almost detective-like stance is crucial.
Trust but verify.
Yeah.
Or maybe don't even trust initially.
Something like that. This also impacts their reliance. An auditor, in the absence of suspicious circumstances, relies on stated facts or figures in the financial records. An investigator, by contrast, does not accept a stated fact as correct until it is substantiated. They will dig until they find definitive proof. They take nothing at face value.
And finally, how do they relate to each other?
Their connection. Investigations can result from the prima facie findings of an auditor. An auditor might find something suspicious during their work that then triggers a more detailed, targeted investigation.
So one can lead to the other.
Exactly. While distinct, they can be sequential. Understanding these detailed differences is paramount for effective application in any professional or exam context. It's a core concept.
Absolutely critical.
Yeah.
So if you're undertaking an investigation, what steps do you follow to ensure it's thorough and effective? Is there a standard process?
Yes, our source outlines a standardized, sequential procedure, which is incredibly valuable for structuring your approach. Think of it as a roadmap. Step 1 is the determination of objectives and establishment of scope of investigation. Absolute clarity from the outset. What does the investigation aim to achieve? If the client's instructions are vague, it's essential to clarify them and get clearly written instructions covering the precise object, scope, purpose, even incidental issues.
Get it in writing.
Always. The period to be covered must also be specified, as changing circumstances like economic shifts or import restrictions can seriously affect the results. This initial clarity is your compass.
Okay, step 1, define the mission. What's step 2?
Step 2 is the formulation of the investigation program. You can't just use one boilerplate program for all investigations. Each situation is unique. The program must be tailored to the specific nature of the business, its organizational structure, client instructions, the required scope and depth. It might even need to extend into books and records belonging to other entities.
Like sister companies again.
Could be. The investigator should concentrate on relevant areas, and crucially, the program must be flexible. It needs to allow for modification as new knowledge is gained during the investigation. For example, in an investigation of suspected payment of wages to ghost workers, the investigator would specifically scan the areas having a bearing on the determination of wages and payments thereof. Focusing on time and job cards, appointment and termination of workers, attendance records, internal controls, internal checks, preparation of wage sheets, withdrawal of money from bank for payment of wages, and the actual disbursement of wages. The goal is to gradually narrow the inquiry to the most meaningful areas to uncover the truth.
Okay, a detailed, flexible plan. Then what?
Step 3 involves the collection of evidence. This is where the investigator meticulously gathers all relevant evidence through examination. Oral explanations from personnel are also critical. If the client is external, you need formal agreement from the business for access. The investigator must look for the most convincing evidence, seeking and examining all available information to reach the truth through elimination and corroboration.
Going beyond what an auditor might look at.
Definitely. Unlike an auditor who might stick to prima facie evidence, the investigator must obtain specifically procured evidence if circumstances demand it, even going beyond the books. They can even enlist external experts, valuation specialists, land registration officials to obtain specific evidence, all while ensuring this process doesn't unduly interfere with the client's regular operations.
So valuing land means checking local sales data, expert reports, not just company records.
Exactly. Thorough corroboration.
Got it. Step 4.
Step 4 is the analysis and interpretation of findings. This requires careful analysis and correlation of facts and figures before reaching a conclusion. The conclusion must be well-reasoned, robustly backed by established facts, and evidenced by proper records and data. Objective interpretation is key, considering broader political and economic factors, the competitive landscape, historical patterns, the fundamental nature of the business. The whole context.
And the interpretation itself.
Should be brief, clear, and free from any ambiguity. This is where the detective work truly translates into meaningful insights.
Makes sense. And the final step.
Finally, step 5 is the reporting of findings. Like all professional accounting work, an investigation culminates in a formal report, addressed directly to the party that initiated the investigation. The report's nature is governed by the client's instructions and the investigator's findings. Important considerations include ensuring the report contains only relevant information, using precise language to avoid misinterpretation.
Clarity is key.
Absolutely. Clearly linking all facts and conclusions to the underlying evidence and explicitly stating all bases and assumptions made, but only if absolutely necessary, as it's primarily a fact-finding assignment. The report must clearly state the nature, objective, scope, and any limitations of the assignment, presented in a structured paragraph format with clear headings and detailed supporting data in annexures.
What if the client restricted access?
Any restrictions imposed by the client and their impact on the investigation must be clearly stated. Crucially, the investigator's opinion, if any is appropriate based on the findings, should appear in the final paragraph. And remember, this is a challenging task, often involving direct engagement with parties whose interests might be affected, making it much more likely for findings to be challenged than in a typical audit.
Right. People might push back hard.
They often do. Beyond these standardized steps, investigations often present special issues and considerations that require careful handling and a, nuanced approach.
Like what kind of issues?
One such issue is sampling versus cent-per-cent verification. The approach taken depends entirely on the specific case. For instance, if you're tasked with establishing the exact amount of cash defalcated by a cashier, you likely have no option but to carefully examine all the cash vouchers and related records. 100% verification is necessary there.
Can't sample when you need the exact amount stolen.
Precisely. However, if the goal is to determine a concern's overall profitability, you may verify constituent transactions on a selective basis, but always taking care not to miss material transactions. The source advises that in investigations, it's always safer to use statistically recognized sampling methods rather than vague test checks when selective verification is permitted. More defensible.
Okay. What about relying on previous audits?
Another critical point, reliance on audited statements. This depends entirely on the purpose of the investigation. If the investigation was launched precisely because of some doubt in the audited statement of account, then naturally no reliance can be placed on it.
Makes sense.
However, if the investigation is for, say, valuing a business or shares, the investigator would be entitled to put reliance on audited materials made available to him, unless they find the audit was carried on very casually or their terms explicitly require fresh testing. Our source mentions historical cases, but cautions that they are long time ago and much reliance cannot be placed on them today due to evolving standards.
So be cautious.
Very. Prudence dictates getting the client's written confirmation regarding the correctness of audited statements. If statements were specially prepared for the investigation by another professional accountant, reliance might be acceptable based on principles like those from the Headley-Byrne case, but the investigator should always check for objectivity and potential bias.
Got it. What about needing outside help?
Assistance of experts is often a practical necessity. An investigator may need opinions from experts in various fields: land valuation, intellectual property, engineering. It's prudent to obtain written general consent from the client at the start of the investigation for costs associated with such expert consultations to avoid surprises later.
Good planning. What if the investigation is part of a fight?
Investigations arising from disputes and conflicting claims. These are particularly challenging and demand the highest degree of impartiality. The investigator must remain objective, above disputes or conflicting claims, and be alert to the possibilities of the information or documents made available to him to be prejudiced. People will try to spin things.
You have to resist client influence.
Absolutely. Whether from a seller aiming for a high price or a buyer seeking a low one, this demands being scrupulously professional and exercising a high degree of maturity and experience. Staying neutral is tough, but essential.
Okay. And the opinion itself?
As for the basis of opinion, the investigator should refrain from issuing speculative opinion. Their opinion should confine to the established facts and nothing more. If facts cannot be properly established, perhaps due to incomplete records, the opinion should be qualified by clearly stating the reasons therefor. Stick to the facts.
No crystal ball gazing.
Definitely not. Regarding futuristic statements, the investigator should refuse to be futuristic. While they may assume that the established trend will continue in the near future, in arriving at the present value of the business, they should not project the trend into any future years to establish a value.
Stick to the present based on the past, not predict the far future.
Exactly. This underscores the fact-based nature of investigations. Finally, retention of working papers is absolutely crucial. The investigating accountant should retain in his files full notes of the work carried out, copies of schedules, and all working papers, annexures, facts, figures, record of conversations, and the like. Everything.
Why is that so critical?
These working papers must link up the figures as shown by the books with the final figures produced. Obtaining a representation letter from the appointing authority is also advisable. This meticulous retention is vital for explaining factors if called upon to give evidence in court, especially if findings are challenged or legal proceedings ensue. Your backup needs to be solid.
Makes perfect sense. Now, beyond these general steps and special issues, are there specific considerations when conducting business investigations, particularly when assessing a company's viability or value?
Yes, absolutely. These delve into the very fabric of the entity being examined, going beyond just procedures. First, studying the overall picture is critical. As the source says, figures are only symbols, and you can't interpret them intelligently without understanding their background.
The context.
Right. This involves understanding group-company relationships, the specific type of business manufacturer, trader, single product focus, its dependence on imports or ancillary businesses. If a business is labor-intensive, its future profitability hinges significantly on skilled labor availability and the quality of management-union relations. Distribution methods matter too.
And you need to look beyond the business itself.
Definitely. Beyond these preliminary inquiries, the investigator must deeply study the character of management, the prevailing economic and political forces affecting the business, like labor disturbances, government policies, and its competitive market position. The impact of all these factors on past profits must be carefully judged.
Okay, what about the financial position itself?
For the economic and financial position, you assess the adequacy of fixed and working capital to support business growth. You project future sales and profit trends, ideally product-wise and area-wise. And you determine if future maintainable profits will yield an adequate return on capital employed. You also check if the business is operating at full capacity or if there's significant room for efficiency improvements.
Then you dive into the P&L.
Yes, a deep dive into the statement of profit and loss is required. Prepare a columnar summary for maybe 5 to 7 years, adjusting for inventory consumed, ensuring consistent valuation. Crucially, analyze gross profit ratios and expense to sales ratios, seeking explanations for any wide divergences. It's about dissecting every revenue stream, how turnover is generated, are sales genuine, customer concentration, apportioning expenses correctly.
Wages are important too, you mentioned.
Very. For wage structure, examine computation methods, rates, industrial awards, labor relations disputes can severely impact profitability. Depreciation and maintenance must be consistent and adequate, adjusting for revaluation. If maintenance costs haven't increased with asset age, find out why. Leasehold properties need provision for dilapidation. Compliance with relevant accounting standards must be verified.
Manager pay.
Managerial remuneration is checked for being excessive or inadequate, adjusting for true profitability and ensuring companies act compliance. Exceptional and non-recurring items are adjusted out to prevent obscuring profit trends like tax inadmissible items or profit loss on asset sales.
Repairs and maintenance need scrutiny.
Yes. Scrutinize fluctuating or abnormal charges. If abnormal, establish the correct normal charge, looking out for deferred expenditure or misallocation between capital and revenue. Finally, identify any unusual year one significantly affected by disputes, calamities, pandemics, fire, war, and eliminate it from consideration for normal business results. Don't let outliers skew the picture.
Okay, that's the P&L. What about the balance sheet?
Turning to the balance sheet, you start with fixed assets. Obtain an age analysis. Book values don't always reveal asset age. Assess replacement needs, obsolescence, scrap value. Verify title deeds. Study maintenance expenses to judge asset upkeep. If assets were revalued, ensure increased depreciation is adjusted. Check compliance with AS 28, impairment of asset for impaired assets.
Investments.
For investments, classify them as long-term or current. Value current investments at lower of cost or fair value. Long-term at cost unless there's a permanent decline. Check how income, dividends, rentals is treated. Sometimes it's cost recovery, not income.
Inventory checks.
Yeah.
Similar to due diligence.
Yes. Inventories must be consistently valued without profit elements. Crucial allowances for damaged, obsolete, or slow-moving items are essential. Physical verification for off-site inventory and appropriate valuation of work in progress are key.
Receivables.
Trade receivables require assessing the adequacy of bad debt provisions made in the year of sale. Scrutinize credit periods. Excessive discounts might signal diminishing demand. Classify debts by age. Determine the debtor-to-sales ratio. Confirm other liquid assets are readily realizable. Assess idle assets, unused plant, excessive cash, obsolete inventory. Eliminate them from net worth, but value them separately.
Liabilities.
For liabilities, ensure they are fully stated, not understated or overstated, not unduly large or long outstanding. Analyze trade payables to ensure prompt payment. Taxation involves reviewing assessment orders, ensuring adequate provision for unassessed taxes, checking for past reopenings, and disregarding temporary tax benefits. Capital analysis checks the balance between debt preference shares versus equity and its reasonableness relative to fixed assets and working capital. Issued terms, especially transfer restrictions, significantly affect share value.
And finally, interpreting all this for the future.
Exactly. Interpretation of figures for future assessment is crucial. For fixed assets, assess future capital expenditure needed for replacement, modernization. For turnover, analyze past trends, marketability, new markets, fully exploited, political economic considerations, government policies, trends, competition, new entrants, cheaper products, market share. For working capital, assess inventory to turnover ratio, prompt payment of trade payables, effect of increased turnover, or new products on inventory receivables payables. When estimating future maintainable profits, adjust for extraneous factors. Stable or increasing profit percentages suggest continued rate. Falling percentages may signal commercial inadvisability for further investment. This comprehensive review forms the bedrock of a robust business investigation.
Wow, that's incredibly detailed. So given all that, what are the different scenarios where investigations are specifically called for? You mentioned statutory versus non-statutory earlier.
Right. Let's clarify that. On the statutory side, these are investigations specifically mandated by law. A prime example is an investigation by an inspector under those sections of the Companies Act. 2013 we mentioned earlier, 210, 212, 213, 216. These often deal with suspected corporate misconduct or fraud.
But our focus is more on the non-statutory ones.
Yes, for this deep dive and for practical application, the non-statutory types are far more varied and frequently encountered in professional practice. Let's look at some key examples.
Okay.
First, an investigation on behalf of an incoming partner. If you're considering joining a partnership, you'd want to know if the terms are reasonable, if your capital is safe, your potential return, your remuneration.
Due diligence for a partner, essentially.
Very much so. The investigation would ascertain the firm's history, scrutinize the partnership deed, capital drawings, goodwill clauses, examine profitability, adjusting for partner remuneration, assess assets and liabilities, including intangibles, contingent liabilities, review orders clientele, loan finance terms, key personnel, contractual obligations. Even the reasons for admitting a new partner and any special clauses for future partners need checking. And ultimately, in a partnership, personal considerations and trust are paramount.
Okay. What about valuing shares in private companies?
Next, an investigation for valuation of shares in private companies. Unlike public companies, private shares don't have a free market, so a professional valuation is necessary for buying, selling, estate planning, etc. Our source describes two main methods for equity shares: the net worth basis, net worth number of shares, including goodwill, revalued assets, and the yield basis, present value of future dividends, requiring profit dividend projections.
How do you determine the rate for the yield basis?
The capitalization rate is determined by investor, company history, reserves, future prospects, even social political factors. Often benchmarked against similar public companies, but adjusted for transfer restrictions or majority holdings. Preference shares are also valued on a yield basis, considering similar company shares and restrictions.
Makes sense. What about for banks considering loans?
Another common one, on behalf of a bank or financial institution proposing to advance a loan. The bank's interests are clear: purpose of loan, repayment sources, security. The investigator delves into the precise purpose, the repayment schedule's assumptions, cash profits, cash availability, financial standing, reputation of directors, company's legal authorization to borrow. They review history, 5 years, assess how broader changes might affect it, check if previous loans were rejected and why.
Verification steps.
Verification includes a condensed income statement, 5 years, calculating key ratios, sales to inventory, equity to fixed assets, current ratio, quick ratio, ROCE, product-wise sales breakdown, meticulous verification of assets and liabilities. Detailed schedules for fixed assets, depreciation, encumbrances, reevaluation, inventory, valuation, slow-moving, pledges, receivables, aging, bad debts, related parties, investments, cost, market value, pledges, loans, secure, unsecured, related parties, tax provisions, other liabilities, insurance adequacy, contingent liabilities, through direct inquiries, legal advisors. Very thorough.
And investigating frauds. You said we'd cover that next.
Yes, the investigation of frauds is a major area, so significant. Yeah. We'll dive into that specifically when we discuss forensic accounting shortly.
Yeah, I know that.
Yes. Investigations on behalf of an individual or firm proposing to buy a business. Objective: collect info for the purchase decision and price. Similar to share valuation, but with some nuances. For proprietary concerns partnerships, additional matters. Reasons for sale, effective owner's retirement, lease-length renewal, unexpired patents, managerial staff, continuity of the liabilities, pensions, customer concentration weakness, goodwill valuation. For limited companies, authorized issued capital, uncalled liability, share classes rights, past dividends arrears, mortgage charges, check registrar of companies, share price, especially for unquoted shares.
And finally,
Finally, investigations in connection with review of profit financial forecasts, examining future profits, maybe for a business purchase or bank loan appraisal. Forecasts are inherently uncertain, not verifiable like historical data, requires a special review, moving beyond the auditor's traditional role. It's about assessing the reasonableness of future expectations.
okay, that covers the different types of investigations really well. This brings us then, naturally, to forensic accounting, a rapidly growing and, frankly, vital field born out of sheer necessity. A direct response to the accelerating number of fraudulent and ambiguous financial activities worldwide.
It really is a field whose time has come, driven by need.
The word forensic itself means suitable for use in the court of law, right?
Yeah.
From the Latin forensis, of or before the forum.
Exactly. And as our source defines it, forensic accounting is the application of financial skills and investigative mentality to unresolved issues conducted within the context of the rules of evidence.
So it combines finance skills with an investigative mindset, all geared toward legal evidence.
Precisely. It's an emerging discipline encompassing sophisticated financial expertise, deep fraud knowledge, a nuanced understanding of business reality, and a working knowledge of the legal system. It's the integration of accounting, auditing, and investigative skills, or, more simply, the application of accounting methods to the tracking and collection of forensic evidence, often specifically for investigating and prosecuting criminal acts like embezzlement or fraud.
And that definition keeps evolving.
It does, driven by the growing needs of corporations, especially in the wake of infamous corporate scandals. Think Parmalat, Xerox, Satyam, Enron, WorldCom, HealthSouth, Bernie Madoff. The list is long.
Those really shook confidence.
They did, and forensic accounting is now recognized as a strategic tool for combating corruption, financial crimes, and frauds through highly specialized investigations.
To make this even clearer, can you distinguish between general forensics and forensic accounting?
Good question. Let's use the source examples. Imagine a CEO gets an anonymous death threat letter. The police undertake forensic analysis, examining the paper, fingerprints, handwriting, ink composition. That's forensics in a broad sense, applying science to physical evidence.
Okay.
Now, consider the accounting officer in a pharma company. He discovers a large discrepancy between physical inventory and book inventory of an expensive raw material. To find out why, he diligently reviews quantities received against production runs, wastage records, no explanation. So he asks security to review CCTV footage.
And fines.
Identifies instances of short delivery from a supplier. Our source explicitly states this detailed analysis by the accounting officer was an example of some forensic accounting techniques to identify a case of accounting fraud.
So the difference is the focus on financial evidence and potential fraud.
Exactly. General forensics applies scientific methods to various evidence types. Forensic accounting applies specialized financial skills and investigative techniques specifically to financial evidence, almost always in the context of fraud and potential legal proceedings. It's about following the money trail with a legal lens.
That distinction is absolutely critical, and it leads us to another key takeaway, especially vital for your exam listener. How is a forensic accounting analysis fundamentally different from a traditional financial audit?
Yes, let's nail this down. There's a persistent public misconception that financial auditors detect all fraud.
But that's not their primary goal, is it?
Not entirely. The truth, as our source emphasizes, is that audits are primarily designed to detect material misstatements in financial statements, not necessarily all immaterial frauds, which can still be significant in aggregate or indicative of bigger problems. Financial audits are inherently limited by sampling techniques and auditors' reliance on examining the audit trail rather than delving into the underlying events and activities directly. Doing the latter would be resource prohibitive for every audit.
Okay, so let's compare statutory audit versus forensic accounting in detail. The source has a table, right?
It does, and it really illuminates the differences. Let's go through the key points. For legal mandate, a statutory audit has a clear legal mandate. Forensic accounting typically does not have a general legal mandate. Its purpose is specifically to support legal cases or internal investigations. Who performs the work? Audits are conducted only by qualified chartered accountants. Forensic accounting, while often done by CAs, also permits non-CAs with the relevant investigative skills.
Interesting. And the output?
The output of a statutory audit is an independent opinion on the financial statements, the audit report. Forensic accounting produces a report of findings of evidence discovered, and it's the court or regulatory body that judges the evidence, not the professional. They present facts, not guilt or innocence.
Objective difference.
Big one, objective. Audit aims for a true and fair view. Forensic accounting's objective is far more targeted, to discover facts and evidence related to specific allegations or suspicions. Their focus also differs. Audit is very general, an overall review of the financials. Forensic accounting is narrow, focused on validating specific transactions, accounts, or balances related to a suspected fraud or dispute.
Approach.
The approach in an audit involves control tests, substantive tests, fundamentally sample-based. Forensic accounting employs focused testing to confirm suspicion allegation and is typically investigative, substantive, or in-depth checking, often looking at 100% of relevant transactions within its scope. The target of an audit is identifying material misstatements. Forensic accounting aims to identify confirmed nature of violation, specifically related to fraud or dispute.
Skills needed.
Different skills. Auditing primarily involves testing, checking, analysis, inquiry, observation. Forensic accounting demands a higher level of scrutiny and analysis, comprehensive fact-finding, and extensive interviews. More investigative. The underlying presumption. Auditor has professional skepticism. Due professional care doesn't assume fraud without evidence. Forensic professional, while neutral, often starts with a hypothesis or suspicion they are testing.
Other differences.
Forensic accounting requires more extensive corroboration. It may focus on seemingly immaterial transactions an auditor might overlook. The period covered by audit is usually fixed. Forensic accounting has no such limitations. For stock asset valuation, audit generally relies on management representations. Forensic accounting conducts independent verification of suspected selected items. For off-balance sheet items, audit checks accuracy compliance. Forensic accounting examines regulatory impropriety to detect hidden dealings.
And if they find something bad?
Nature of adverse findings. Audit expresses a negative qualified opinion. Forensic accounting results in a legal determination of fraud impact and identification of perpetrators depending on scope, potentially leading to legal action. These comprehensive differences underscore why it's a distinct, specialized discipline.
Absolutely clear. Now that we understand its distinct role, let's discuss the various forms fraud can actually take. The source categorizes them, right?
It does, broadly into three main types, but with many specific examples under each, showcasing the vast ingenuity of fraudsters.
Okay, what's the first category?
First, fraudulent financial reporting. This involves intentional misstatements or omissions in financial statements to deceive users. Think cooking the books. Alteration or falsification of records, misrepresentation or intentional omission of significant info, intentional misapplication of accounting principles. Specific tactics include fictitious journal entries, adjusting assumptions to manipulate results, omitting or delaying recognition of transactions, abnormal year-end deals, improper asset valuation, overstating revenue, understating liabilities, all to make the company look healthier than it is.
To attract investors or hide problems?
Exactly. Second category, misappropriation of assets. This is essentially theft or misuse of a company's assets, often called employee fraud.
How does that happen?
Outright theft of cash, like skimming, theft before recording, or cash larceny, theft after recording. Stealing physical assets or intellectual property. Setting up fictitious vendors for false payments. Payroll schemes are common. Ghost employees, falsified wages, commission schemes on inflated sales, expense reimbursement schemes, mischaracterized, overstated, fictitious, or multiple claims for the same item, and simply using entity assets for personal gain.
Okay, and the third category?
The third broad category is corruption. This involves misusing one's position for personal gain, and it often occurs off-book, making it incredibly difficult to detect through traditional audits.
Examples of corruption.
Conflict of interest, where personal interests clash secretly with the company's. Bribery is a major one, official, influencing government, or commercial, influencing business decisions, often involving kickbacks or bid rigging. Illegal gratuities, giving value after a favorable decision. Economic extortion, demanding payment by threat. And finally, money laundering, concealing origins of illegal money, often cycling it through legitimate businesses.
Wow. And the source list is even more specific types, doesn't it? Just to illustrate the sheer range.
It does. It's quite a list. Really highlights the challenge. There are fraudulent entries, wrong entries, sales frauds, price enhancement, omitting scrap sales, billing sales reversals, yield ratio suppression, asset sale as income, cash as credit sale, writing off good debt.
Collections.
Expenses. Collection frauds, charity scams, donations to loan accounts, unrecorded cash rentals. Expense frauds. Ineligible discounts, overcharging, falsification, untimely payment, fictitious vendors, unnecessary provisioning.
Payroll. Data.
Payroll frauds, extra employees' hours, rounding off theft, undeactivated IDs. Data frauds, changing computer data, destroying, suppressing, inserting records.
Technology must be a big area now.
Huge. Technology-related frauds, malware, phishing, smishing, whaling, card duplications, stealing confidential data, banking-related frauds, forged signatures, check frauds, alteration, kite flying, cash lending scams, missing notes, wrong posting, misused stationery, ATM PIN misuse, advances on inflated statements, documents.
Any others jump out?
Teaming and lading, lapping collections is a classic. Process houses mixing inferior materials. Pilferage, selling classified info, withholding info on free schemes, misusing trust FDs, fictitious journal entries.
What about fraud specifically for personal gain?
The source points to bribery again, official, commercial. For corporate frauds, irregularities, there's advance billing, booking fictitious sales, using shell dummy companies for fund diversion or fictitious bills, falsification through wrong expense classification, inflated claims, multiple reimbursements.
And money laundering.
Yes, money laundering activities converting illegal money via banking, often through weak controls or benami proxy transactions. Cash-heavy businesses are susceptible.
And frauds by operational staff.
Fraud at operational level employees. Tampering checks, online payments. Off-book frauds. Cash theft before recording, hard to trace. Cash misappropriation after entries passed. Teaming and lading again. Fraudulent disbursements, reimbursements. False personal bills, inflated refunds. Payroll fraud, non-existent staff, inflated pay. Commission schemes, exaggerating sales, altering prices, kickbacks. The variety is truly staggering.
It really is. With such a wide array of potential frauds, how do investigators actually proceed when fraud is suspected? What's the procedure?
The procedure for investigating fraud is systematic and highly focused, almost like, well, a detective building a case. Initially, the investigating accountant should ascertain the exact duties of the person concerned who is suspected, his relationship to the general routine, and the circumstances in which any known instances have come to light.
Find the potential weak spots related to that person.
Exactly. This gives a powerful clue to promising avenues, narrowing the field. If the fraud's details are unknown, the accountant must meticulously study the organization's financial accounting structure, line of responsibility, internal control weaknesses, especially focusing on areas with excessive control in the hands of single persons. Opportunity is key.
Okay. What about verifying cash? That seems crucial.
Extremely. For verification of cash receipts, the process is incredibly detailed. You scrutinize evidence as regards income received from different sources. Inventory records, sales summaries, rental registers, correspondence, carbon copies of receipts checked against issued receipts, bank paying-in slips compared with cash book daily, scrutiny of scrap sales, rent collections, refunds, voucher cash sales meticulously, review cash discount deductions, check bank withdrawals against passbook.
Trying to find any discrepancy.
Any way cash could leak out or be misreported. For verification of cash payments, the focus is scrutinizing all evidence, acknowledgments. Any altered figures on receipts confirmed directly with parties, bearer checks examined closely, wage recording system reviewed for overtotaling or dummy workmen, ordering receiving systems checked no payment for unreceived supplies, confirmations from partners directors for payments to them, petty cash book vouch totaled, bank withdrawals cross-checked.
Looking for false payments, basically.
Or inflated ones or double payments. Frauds through supplier's ledger require meticulous verification. Purchase journal vouched against goods inward book invoices. Request statements directly from suppliers to confirm balances, allowances, rebates, independently verifying company records. Examine internal controls for collusion possibilities, fictitious invoices, suppressed credits, inflated prices.
And the customer side.
For customers' ledger frauds, pay special attention to unusual allowances, uncharacteristic bad debts. Cross-check order book with sales day book. Crucially, obtain customer confirmations, even for zero balances, to ascertain genuineness. This helps detect teaming and lading, misappropriating funds, then crediting later false allowances.
And finally, inventory fraud. How do you tackle that?
Inventory frauds involve various schemes. Physical removal, writing off goods stock as damaged, manipulating records, inflating issues to cover losses. The verification procedure requires reviewing the entire system: receipts, storage, dispatch. First step: establish items quantities defalcated by physical check versus inventory book. Ascertain duties of handlers again. Look for excessive control by one person. Verify receipts issues against registers documents. Reconcile shortages from physical count with book discrepancies. For industrial concerns, verify raw material issues, finished goods receipts against production norms.
What if management is involved?
If management is suspected of inflating wastage or issues, an engineer's assistance is often thought to determine actual wastage factors, machine capacity, using past records as a critical guide. This comprehensive approach is essential for uncovering and substantiating fraud.
Makes sense. So with all these potential areas for fraud, what are the warning signs, the red flags that something might be amiss? What should make you pause and dig deeper?
Good question. These are indicators that demand caution. Our source lists several key ones. First, discrepancies in accounting records. Things like non-recording, partial incorrect delayed recording of transactions, or misclassifications of accounts, often the first tangible signs.
Things just don't add up.
Exactly. Second, conflicting or missing evidence. This is a big one. Missing documents, altered documents, significant unexplained items and reconciliations, discrepancies between internal records and external confirmations. When evidence doesn't align or isn't there, that's serious.
Raises immediate questions.
It should. Third, unacceptable management responses. Management denying timely access to records, facilities, employees, putting undue time pressure on resolving complex issues, unusual delays in providing info, denying use of computer-assisted audit techniques, CAAs, unwillingness to address internal control weaknesses.
Defensive or obstructive behavior.
Strong indicators they might be hiding something. Fourth, other indications include accounting policies varying significantly from industry norms, or frequent unexplained changes in accounting estimates without clear justification. Deviations can signal manipulation.
Okay, and there's a framework for why fraud happens, the fraud diamond.
Yes, The Fraud Diamond by David T. Wolfe and Dana R. Hermanson. It highlights 4 elements necessary for many frauds, especially sophisticated ones. It's a confluence of factors.
What are the 4 elements?
First is incentive. I want to or have a need to commit fraud. The pressure or motivation, financial distress, greed, performance targets. Second is opportunity. There is a weakness in the system that the right person could exploit. Fraud is possible. The pathway: poor controls, lack of oversight, complexity.
Third
is rationalization. I have convinced myself that this fraudulent behavior is worth the risks. The internal justification, I'll pay it back, the company owes me, allows them to see themselves as honest.
And the crucial 4th element.
Capability. I have the necessary traits and abilities to be the right person to pull it off. I have recognized this particular fraud opportunity and can turn it into reality. This emphasizes that the other 3 aren't enough. The perpetrator needs the skill, intelligence, position, confidence to exploit the weakness repeatedly, often knowing how to bypass controls. It takes a certain kind of person.
Incentive, opportunity, rationalization, and capability.
Spelled out.
Fraud diamond. Got it.
Yeah.
So what happens once fraud is suspected or detected? What are the required responses?
Well, professionals, particularly auditors, have specific responses outlined in standards like SA 330, an Indian auditing standard on responses to assessed risks. These aim to mitigate the risks and address the fraud effectively. An auditor needs to assign appropriate personnel, considering skill, ability, evaluate accounting policies for red flags, and incorporate unpredictability in audit procedures to keep fraudsters guessing.
What about management overriding controls? That seems like a big risk.
It is. Responses to risks related to management override are crucial. This includes testing the appropriateness of journal entries and other adjustments, reviewing accounting estimates for biases, and scrutinizing significant unusual transactions outside the normal course of business. Auditors must assess fraud risk factors, incentives, opportunities, rationalizations as part of their risk assessment.
And communication.
Responses also include communicating findings to management and those charged with governance, and, when necessary, to regulatory and enforcement authorities. Thorough documentation of risk assessment and responses is vital too.
But auditors can't catch everything, right?
No, and it's critical to understand the auditor's ability to detect fraud. This ability depends on factors like the skillfulness of the perpetrator, frequency, extent of manipulation, degree of collusion, relative size of amounts manipulated, and seniority of individuals involved. Sophisticated, collusive fraud is harder to detect.
So detection risk.
As the source states, detection risk can only be reduced, not eliminated. It's a continuous challenge.
Can you give an example of investigating potential fraud?
Sure. Let's consider a scenario similar to Test Your Understanding 2 from the source. A company suspects inflated manpower expenditure in its effluent treatment plant section. Employees use time cards. As an investigator, a key procedure would be to analyze the attendance record of employees pertaining to that section with regards to in and out time to find discrepancies.
Look for odd patterns.
Exactly. Furthermore, you could conduct surprise visits to the site to see the actual number of workers at a point of time. The source notes that, quote, discrepancies in attendance records vis-a-vis actual number of workers present could reveal dummy workers or ghost workers, a common payroll fraud.
The surprise visit catches them out.
Potentially. Such a visit would also provide an indication of actual work done and give an inkling of productivity, providing crucial context. This directly applies the investigative mindset and procedures for uncovering payroll fraud in a practical setting.
That makes it very clear. So who are these specialized professionals, the forensic professionals, and what exactly do they do on a day-to-day basis?
Right. A forensic professional is retained to analyze, interpret, summarize, and present complex financial and business-related issues in a manner which is both understandable and properly supported.
Making complex financial stuff understandable, especially legally.
Exactly. They are uniquely trained to look beyond the numbers and deal with the business reality of the situation, connecting financial anomalies to operational truths. A forensic professional must ensure their firm has the necessary skills and experience. It requires detailed knowledge of fraud investigation techniques, a firm grasp of the legal framework, understanding various fraud types, and crucially, how to collect evidence properly so it stands up in court.
Where do they typically work?
They can be in public practice or employed directly by insurance companies, banks, police forces, government agencies, other organizations that frequently deal with financial disputes or crimes.
What kind of services do they offer?
The indicative services are broad and critical, investigating financial statement manipulations, tracing fund diversions and assets, performing anti-money laundering activities, assessing license fees, dues, tax evasion, analyzing related party transactions valuations, providing valuations or estimations of loss damage in disputes. They also get deeply involved with suspicious transactions under frameworks like the Insolvency and Bankruptcy Code, IBC, in India.
What areas are they involved in day to day?
Their involvement areas are expansive, assisting in legal proceedings, expert witness testimony, preparing visual aids, fraud prevention, reviewing developing internal controls, computer forensics, data recovery, analysis, presentation of digital financial evidence, and, of course, fraud detection, investigating financial evidence, tracing misappropriated funds.
What key skills do they need?
To perform effectively, they must be familiar with legal context procedures, have expertise in IT tools for advanced data analysis, and critically, be able to identify substance over form, seeing past the financial presentation to the underlying economic reality or illicit activity, seeing what's really going on.
Can you illustrate that with another scenario?
Yes, consider an example similar to Test Your Understanding 3. A floor covering manufacturer, X Limited, has product liability insurance with a claim series clause. Multiple claims from one cause count as one. They face a huge 5 crore rupee damages claim due to faulty products causing skin ailments in a 5-star hotel. As a forensic professional appointed by the insurance company, you face unique challenges.
Such as?
Firstly, many documents are required from third parties, like the hotel or guests, who might be unwilling to provide relevant documents. Information hurdles right away. Secondly, the independence of forensic professional becomes paramount, as you're engaging with parties not directly claiming from the insurer. You must resist bias. Thirdly, the company might negotiate the claim to save face, leading to additional complexities. Fourth, quantification of legal liability under the policy can prove challenging and must strictly follow policy terms and law.
And that claim series clause?
Yes, finally, a careful analysis of date of loss when first claim occurred in accordance with claim series clause is crucial to determine if it falls under the policy period. This illustrates the complex, multi-party dynamics and legal nuances forensic professionals navigate.
Definitely complex. Given that complexity, how does a forensic accounting assignment actually proceed? Is there a standard process, even if each case is unique?
Yes, while each assignment is unique, there are general steps that provide a clear roadmap for action. Step 1 is initialization. Clarify the real motive, purpose, utility. Meet the client, get the facts, players, issues. Conduct a conflict check for impartiality. A preliminary investigation is often useful before developing the detailed plan.
Get the lay of the land first.
Exactly. Step 2 is to develop the plan. This plan incorporates knowledge from the client meeting and initial investigation, setting out clear objectives and the detailed methodology. It's your blueprint.
Step 3 is getting the evidence.
Step 3 involves obtaining relevant evidence. Locating documents, economic info, tracing assets, identifying persons for interviews, engaging experts, gathering proof of events. You must fully understand the fraud-type mechanics to get targeted evidence. The evidence must be sufficient to prove identity, if applicable, the scheme, the loss amount. Skilled collection, clear chain of custody, alertness to falsified damaged documents are paramount for court admissibility.
Then the analysis.
Step 4 is to perform the analysis. This varies widely. Calculating economic damages, summarizing complex transactions, tracing assets, present value calculations, regression sensitivity analysis, using computerized applications, spreadsheets, databases, creating charts, graphics to explain findings clearly,
Making sense of the data.
and presenting it effectively. Step 5 is reporting, the final crucial step. A formal report detailing fraudulent activity, if found, loss amount, involved parties. It includes nature, scope, approach, limitations, findings, opinions, all supported by schedules graphics, often discusses how the fraud worked, controls bypass, and may recommend control improvements.
If it goes to court.
Step 6 is court proceedings. If legal action follows, the investigative team is involved. Evidence presented clearly. Team members may testify as expert witnesses, explaining findings, methodology, how suspects were identified. The whole process ensures legally sound conclusions.
Okay, a thorough process. Finally, let's talk about the standards that govern this critical work, ensuring quality and consistency. You mentioned FAIS 510.
Yes, the Forensic Accounting and Investigation Report, specifically FAS 510. A key standard for you to know, listener. This standard deals with the professional's responsibility to issue a written report at the conclusion, multiple reports if multiple assignments.
What are the requirements for the report?
A written report must be issued clear, accurate, based on reliable, relevant evidence, precise and unambiguous language, the report addressee and distribution, addressed to the primary stakeholders who engaged you, shared only if legally required or contractually permissible, keep it confidential otherwise.
Is there a fixed format?
No fixed format or content mandated, but it must include key elements. Title, address distribution, precise scope objectives, approach procedures, executive summary, key findings up front. Also, reference to expert assistance, statement of FAI's compliance or material departures, detailed findings supported by evidence sources, specified assumptions, limitations, disclaimers, and clear conclusions. Ensures the recipient understands context and reliability.
What about discussing drafts?
A discussion of draft report might be required by the mandate with the subject party, upholding principles of natural justice. If so, their responses must be included. Assumptions and limitations must be clearly listed. Any limitations, lack of management support, restricted access, short timelines must be covered as they impact scope and findings.
And the report doesn't assign guilt, right?
Absolutely crucial point highlighted by the source. The report shall not express an opinion or pass any judgment on the guilt or innocence. The determination of culpability is either a disciplinary process or a judicial process. The report's role is to highlight the circumstances and facts that may aid a stakeholder decision or further a civil or criminal investigation, providing objective evidence.
Timelines.
Reporting timelines should be reasonable and agreed. Interim reports, if needed, are also subject to this standard.
Okay, that covers the report standard. What about the overall framework, the FAI system?
Right, the overarching framework ensuring quality. The Overview of Forensic Accounting and Investigation Standards, FAIS, published by the Institute of Chartered Accountants of India, ICAI, to enhance quality and uphold standards. The framework governing forensic accounting and investigations lays down principles boundaries, aims for overall understanding how components interrelate, improve service quality, founded on the Code of Ethics.
What are its components?
4 mandatory components, pillars, basic principles, key concepts, standards on FAI, and guidance. Guidance itself is recommendatory, the other is mandatory. The purpose of FAIs is multifaceted. Minimum standards for professionals, quality indication for users, appreciation for regulators GOFT, implementation guidance.
How are the standards applied?
Their nature is principle-based rather than rule-based, allowing professional judgment and adaptability, including use of digital forensic tools. Application varies with engagement nature.
What if you can't comply?
Key point for professionals. If unable to comply or there's conflict with other mandates, the FAI report must draw attention to the material departures therefrom along with appropriate explanation. Transparency is crucial. The standards are classified by series: 100s, key concepts; 200s, engagement management; 300s, executing assignments; 400s, specialized areas; 500s, reporting where FAS 510 is; 600s, quality control.
Can we link this back to the Surratt Company case?
Yes, let's revisit that initial case. The company with the NPA and sister concern transactions suspected of fund diversion. A forensic accounting investigation following these FAI's principles would meticulously analyze elements like the PCL and bills purchased facilities to understand the purpose of funding. It would rigorously scrutinize 4X transactions not in accordance with imports and exports. Crucially, it would analyze transactions with sister concerns for probable fund diversion and siphoning off, ultimately seeking to dig out trail for end use of funds.
So the VAS provides the rigorous, legally defensible framework.
Exactly. For such complex real-world fraud investigations, ensuring findings are robust and actionable.
And this ties into potential exam questions.
Directly. Questions discussing the overall process of forensic accounting, key report elements under FAI's 510, or the fundamental differences between audit and forensic accounting. Mastering these standards and processes is absolutely essential for applying this knowledge effectively in your case-based exam and your career.
Fantastic. We've truly peeled back the layers today, haven't we? Moving from the foundational prudence of due diligence through the specific, deep inquiries of investigations and into the precise, court-ready world of forensic accounting.
It's been quite the journey, from general care to deep, legally defensible fact-finding.
Each with its own unique purpose.
And for you, our dedicated learner preparing for exams or just seeking clarity, remember those core distinctions we hammered home today. Due diligence, care before a transaction, preventing problems; investigation, establishing a fact for a specific, often historical purpose; forensic accounting, using specialized skills to gather evidence suitable for legal proceedings, often related to fraud, where culpability might be determined.
Each serves a distinct, vital role in maintaining financial integrity and transparency.
Absolutely.
It's truly fascinating to me how these specialized areas, while distinct, often dance around the same core questions about financial integrity, yet serve very different ends.
They're all about understanding the truth behind the numbers, but for different reasons and with different levels of legal rigor.
And you mentioned demand is growing.
Definitely. And here's where it gets really interesting for you. As information explodes, financial complexities grow, globalization continues. The demand for professionals who can navigate these intricate domains will only increase. Think about how rapidly digital evidence is evolving and becoming central to these fields. The future of financial integrity relies heavily on these skills.
So what does this all mean for you, our listener? It means mastering these distinctions isn't just for an exam. It's about being equipped to be a critical thinker in a world overflowing with data, identifying not just the numbers, but the full story and the truth behind them, developing that professional intuition.
Well said. And a final thought for you to mull over. Consider how advancements in artificial intelligence and big data analytics might further blur or sharpen the lines between these three disciplines in the coming years.
Oh, interesting.
What new capabilities will emerge for forensic professionals? And what new ethical challenges might they pose privacy, algorithmic bias, and detecting fraud? The field is constantly evolving, and your foundational knowledge is just the beginning of a fascinating journey.